Hello, everyone. Welcome back. My name is Michela from Binance Institutional, and I will be your host for today. A quick reminder before we start today's episode, as usual, digital asset prices are subject to high market risk and price volatility. This means that the value of your investment might go up as well as down, and you might not get back the amount invested. You are solely responsible for your own investment decisions, and the conversations taking place here today do not constitute investment advice of any kind. That being said, welcome to our second episode of Binance VIP Voices, a space where we will be delving deep into the minds of the biggest institutional players and leaders in this industry. Our podcast covers quite a variety of topics in the world of digital assets, such as institutional adoption, institutional trading strategies, crypto asset management, and more. For the ones wondering what Binance VIP and Institutional is, here's everything you need to know in a nutshell. Binance VIP and Institutional caters to all type of institutional investors. We work closely with a wide range of market participants, including professional asset managers, high-frequency trading firms, prop trading firms, hedge funds, family offices, market makers, VCs, brokers, investment banks, and more. The time has arrived to kickstart this episode, and this one promises to be a very insightful one. We will be picking the brain of what I consider one of the most well known professionals in the field of quantitative strategies. Let me introduce our speaker, a little bit of mysterious down here. He's the partner and head of Fasanara Digital, the cryptocurrency division of Fasanara Capital. Our speaker started his journey in the world of finance by founding the Quant Group, a research team dedicated to crafting quantitative strategies for crypto markets. In 2018, the Quant Group was integrated into Fasanara Capital, evolving into what we know today as Fasanara Digital. The academic journey of our speaker is quite impressive, with a Bachelor of Science in Mathematics earned from the University of St. Andrews. He's also one of the few quants in this industry to be considered or to make it to Forbes 30 under 30. Welcome to VIP Voices, Nikita.
Hello, it's great to be here. Thank you for the opportunity.
Well, it's quite a pleasure to have you in our second episode, and we would like to know more about your personal story, your career trajectory, and maybe a sneak peek into your exciting projects at the moment.
Sure, I'm very happy to. I guess quickly a bit of background. As Michaela said, I started looking at the crypto market in 2017. So it was quite early days for the asset class. So it was when the BitMEX was the reigning king of the crypto exchanges, and so we started playing around there little by little, essentially building out our knowledge, starting to trade the asset class. And I was always really keen to take a look and get dirty, trying to understand things, really, play around. And effectively, what I did is I created this team, the Quant Group, and we started, just together, understanding what's going on. And so fast forward, we were playing around for about a year. We had some good, promising results. Thought about how to pursue this adventure professionally. And so this idea of launching a hedge fund was always a dream. And we did, just like I guess everyone else is trying to after they graduate, to actually launch a fund. And so we partnered up with Fasanara Capital, and were given a pretty unique opportunity and a seat to get the backing of an institutional player and leverage their brand and network to build out the crypto strategy. And in 2018, when we started, it was really early days for the asset class. And for us in particular, well, because we knew nothing and experience was very, very limited. And so the journey was quite long to some extent, and the learning was quite steep. So we kind of were given to seats and kind of tasked with an idea of, well, building the fund from scratch, and little by little we started. to become more sophisticated, try to diversify the risks, try to be better and faster with expressing our views. And but the fundamental pillars that we're focused on throughout were really, playing the long term game, expressing uh, hedged bets, and in a market neutral fashion. And that's kind of were, few things that we started to keep an eye on, and build around our business and our operation.
Yeah, well, they interested at all. Like this is a career journey that is nothing short of extraordinary. I would say also, could you share with us a little bit more of your conference coming up in London? Everyone is looking forward for it.
Yeah, indeed, indeed. It was also like a quite funny story. So while I was starting the Quant Group in university, I also created the Quant Conference. I had this idea, which, maybe will play out at some day, of having this the group, which is, holding company of a bunch of things that, that we're engaged in. And so the Quant Conference, as it came to be known, was my idea of trying to give a platform and discuss some of the cutting edge ideas that are happening in the quant space. So, back then as a student, I couldn't really attend many conferences, well, for financial reasons, and then I was like, okay, why don't I try to create my own? And so that was actually, quite important for us, because it led us to find, majority of the talents for the early days, but also, following, investors, and lots of opportunities came because of it. So we hosted it 5 times, and then now we rebranded it and exclusively focused it on the crypto. So it's called the Digital Asset Conference, where we'll be essentially again hosting creating this platform for the institutional players, so big TradFi legacy institutions, to meet the rapidly growing digital asset ecosystem, and hopefully fostering the growth and wider adoption of the technology.
Hopefully, it will be a great one to remember, one for the books. Well, it's time to jump headfirst into the most important part of this episode. I would say full speed ahead. And the first question focuses on trading philosophies. Good portfolio managers have philosophies that go beyond a simple statement of saying, well, I'm a value investor, just a growth investor. I would say, what is the step that you followed in the first few stages of your career to create a solid investment philosophy, Nikita? What is that
Yeah.
methodology for you?
So I think, I think it's really personal. It's like a matter of taste. Every single, individual and portfolio manager, chief investment officer, whoever is in a position of, taking bets, making, putting capital at risk, they need to be really, honest with themselves, and really understand deeply um, the chemistry, and how their mind works and how they tick. And that's, I think, is like the first and really really vital step in the journey of any, money manager. And so for me, like, I spent tons of time studying the grades, and reading a lot of biographies, and so on, to really try to parse through how some of these guys derived their philosophy. And so for me, it was really, again, going to the basics, to the first principles, and really thinking like, what do I like, and what do I enjoy, and how do I think about risk. And so what was definitely clear is that I'm really, analytical, and pursuing some quantitative strategies is the way. Like, I really want to, with almost deterministic fashion, know why we make money and why we don't make money. And so that's kind of really important. And then the other is what's your appetite for risk. And so that's kind of is, really philosophical, and it really depends on what asset class you trade, what you're optimizing for, and so on. But for me, it was like really trying to think long term, and how to, as we, build up our confidence in our strategies and the knowledge, is to really, take very little risk, and as we become, better and better, to incrementally, shift the gears. And so I guess to answer the question, the philosophy is to really pursue market neutral arbitrage strategies that are focused on harnessing market structural market inefficiencies, and operate with a technology first approach.
Thank you for that. Which is a great step-by-step framework, I would say, for someone that is starting. Also, I think through how your journey, you have come across two type of asset managers, right? The ones that come from TradFi and the ones that emerged directly from crypto. What recommendations will you give to TradFi asset managers that are looking to start allocating into digital assets? Right? Is there a set of steps that should be taken in order to integrate crypto strategies into their existing portfolios without disrupting that much their business model?
Yeah, well, so that's I think is quite complex and quite specific question. So it could, the answer could be quite different depending on who, what kind of asset manager it is. But I'll try to give some, I guess, some ideas and some thinking points that could be relevant to some. And so I think first of all, you kind of need to think about it in terms of a portfolio construction and have a lot of diversification, both in terms of time and in terms of strategies. So if you're taking some directional exposure, well, be sure that you understand what volatility means and how it works, because people really like when volatility is upside, but then they like it a bit less so when it's downside. And so having time diversification is quite central, which is to say that you invest over quite prolonged period of time, always leaving bullets for the future. But then equally, should you want to pursue some less liquid strategies, so be it venture or some trackers, then conversation complicates quite a bit. And I think like investors need to keep in mind and place it in the right pocket of their overall strategy, and that should be driven by what do they perceive their edge to be. Like, are they great in evaluating managers? Are they great in taking risks themselves? Are they great in understanding and finding some early stage opportunities? So, and that will kind of dictate which segment of the market to look at. But I think above all, the mindset should be that the transferable knowledge is quite limited. The common sense is useful to have, and it's not necessarily always common among different market participants. So you kind of need to be in a mindset to be a learner, to be day zero kind of endeavor. Should you want to start in crypto and really try to go very deep and question everything, so that you kind of firmly understand all of the boundaries of how things work.
Yeah, and coming back to the point of TradFi asset managers, right? Many TradFi quant funds this are experiencing the first ever crypto winter, or the first bearish market. How would you identify, right, the primary factors that enable quant funds in general to drive in those bearish market conditions? If you could look back at your first bearish market, what primary factors will give you the hints that um, how will you drive this bear market, say like this, and if you could look back, what mistakes you could have
Yeah,
avoided?
well, so I guess it a bit depends on your strategy, right? The if you're market neutral, then you could be hedged and you might not be necessarily very exposed to market price risk. But then if you could be very much exposed to the exchange risk, for example, or other service providers or sell side risks. But then if you're a directional fund, then you're very likely really exposed to some of the price drops and just overall market volatility. And so I guess some of the key principles are again around diversification and really strict strict and tight risk controls. Like in crypto, things change really quickly, and so you need to be always, quick to adapt and react and incorporate new information, and have systems and processes in place to press rage quit button, so that you're out, and really think what the triggers could be, and should they become more likely, then you kind of start acting proactively. And and we've seen this with, with some exchanges collapsing. We've seen this with some of the hacks, some of um, the pegs, and some of the things like that. I think it's a lot of people are just not too well prepared for such moments, and that leads to, a lot greater risk that you're taking. So for bear markets, you just need to really strike a right balance between risk and reward. Maybe reward is a bit less available, again depending on the strategy. So you should be a bit more careful with all the risk, because and there is a lot of cross correlations between different risks and risk factors.
Thank you for that. Now let's redirect the conversation to market dislocations. And I have been following you for quite a while, and I really like your approach on how to make use of those market dislocations, right? From of course the perspective of a quant fund. Why should asset managers pay close attention to them, Nikita?
Well, so market dislocations. Maybe I'll just spend a second, like explaining like why they arise, and then why people should keep an eye on it. So I guess like fundamentally, the mispricings, they happen for ample reasons. Should there be no exogenous factors, meaning like exchanges not, like withdrawals are working, there is no risk of insolvency and so on. So you just kind of assume that there are 5, 10, 20, whatever many exchanges that are well behaved. So at that point, there are a lot of different market participants that are of various degree of sophistication, and so they're looking at the local price, which they it's kind of generalizes quite well to other industries, or like to just economies. It doesn't necessarily mean that a price in different cities for the same product should be exactly the same, right? There is no perfect dissemination of information. And so the more developed the system becomes, the more well funded and smart HFT firms, market makers come into the picture, the better synchronization is across all the and information, and like and distribution and price discovery happens across different coins, different exchanges, different instruments. And so effectively, the way it kind of works in an illustrative way is that somebody buys on exchange A, and so they move the price out of sync, and then the market participants, the well-informed ones, they're looking at globally what the price is, and they're like correcting those mispricing. So it's effectively a pretty important role that market makers and arbitrageurs are performing, is that they're improving they're keeping markets better synced, and they make them more liquid, so that effectively people with a view, some directional traders, some fundamental investors, or private equity venture guys, long only guys, whoever, that they could come in and like buy the market, even through just one venue, and get a pretty good feel, get pretty good price. And so why asset managers and all the rest should kind of think about it is, well, it's ultimately their ability to build a pretty big position in this asset class, in this instruments. And that's it's obviously a pretty strong requirements, because if the liquidity is not there, then people can't really run much money. They can't really express bets in the size that they would want. So liquidity begets liquidity, and that's kind of what is quite central to the efficient market operation.
Yeah, and I will take the last note to make the intersection with the next question. You spoke about market dynamics and how different and how important is the different roles of different players in the ecosystem, right? With that, client expectations are evolving all the time as we speak. And as we approach the end of the year, what will you identified as the most prominent challenges that quant-focused asset managers have encountered through this year, and how you anticipate those challenges evolving in the next year?
Well, I think the challenge for the whole industry was how the 2023 looks post FTX, because that's was a pretty central blow for the whole industry, and so there were like a lot of repercussions. I think the way market participants, especially like on the institutional front, interact with exchanges is changing little by little. So I think like exchanges and investors really appreciate the risk of exchange being also custodian, which obviously it's a bit of a legacy thing, but there are some solutions that are offering alternatives to it, and that becomes progressively more so the industry norm. So that's kind of one trend. So kind of going more towards this of exchange tri-party solutions and things like that. Then vibrancy of the whole ecosystem in terms of some other dark pools that are starting to be available, some credit market that starts to be more viable, some or revival of the credit market, and essentially just effectively like for the more the investment community, for them it's really trying to question their thesis, and if it's unchanged they just keep on doing what they're doing. If it changed because of rates, because of greater competition, or maybe not viability of their strategy for many different ways, then maybe they should do something else. But effectively I think like the landscape is much more competitive and you need to know your edge, and in order to to have a seat at the table. But that's kind of pretty good because eventually there is a process of maturation, and when there will be more and more institutional players in the space, there will be less room for worse bad actors, and market can actually leg up and keep on growing.
And you also said something very important, which is find the edge. I will say that's one of the most important lessons of this episode. And in this end, many of the quant funds find that their edge is on the data. Based on this, how do asset managers integrate real-time data, and how do you particularly, maybe Nikita, adapt those predictive models to make more informed decisions that ultimately lead to positive returns?
Yeah, so I mean there is like a lot that goes into it, and obviously if you want to compete on the market microstructure level in the HFT game, then this is huge topic, and some firms invest quite substantial amount of money to just be the first one for the after the market ticks, to adjust their quotes and do all sorts of sophisticated analysis and strategy improvement, to really be at the forefront of innovation. And I think that's kind of progressively becomes less and less available just because the upfront costs are so high, and I think just in general there is no space for 200 market makers. I think there will be progressively less and less room, and it will be a bit more concentrated. Kind of the bigger guys will keep on being bigger. There is obviously like a bit of dynamics with some of the regulation, but to kind of answer the question in terms of data, I think there are like, a lot of solutions out there, third party solution services that kind of give you this and make it easily digestible and integratable, should you want to. And that's kind of is quite useful because a lot of the market participants, they're not really expecting to build out their whole tech stack and build their whole execution engine and all the back office, front office, and so on. And but that's kind of was a requirement a few years ago, just because service providers weren't any good or weren't advanced enough. But now there are like actually quite a good suite of products out there, and so data in terms of real time, historic, and whatever else. You could actually get many different alternatives and pick whatever flavor is your favorite.
This is really, really gold, and I think a few people seeing us today are taking notes of everything you're recommending. Thank you for those. And looking back at the topic of hypotheses, right? Quantitative trading approaches often involve iterating between them sometimes. How frequently should an asset manager typically refine those hypotheses, and what triggers are critical for the team to revisit and adjust those hypotheses? Or, in your opinion, your experience, how often do you revisit those?
Well, so I guess hypothesis is start of a research. So you kind of think you maybe observe something and then it looks a bit strange, and so like a question pops up into your mind, and so you you can try to formulate some hypothesis, try to make a guess for why that is, and then using data answer it. Sometimes with quite high confidence why that happens, and so this kind of approach can be quite useful in coming up with some improvements or new strategies or some incremental refinements. And so I think it's healthy, and it's probably quite useful to formulate hypotheses about as many things as possible, and iterate quite frequently on them. So because markets change quite frequently, and you should kind of always question whatever beliefs that you have, so that you could frame them and update your priors and get closer to what is the latest. So for the asset managers, it's quite difficult to generalize, because they usually have much longer time horizon for trades than some HFT firms. So for them, it will the approach will be somewhat a bit different. They can still take a bit of inspiration from it, but they would be looking at longer time horizon, and there will be just a bit different mindset. But for what we do, it's really important to formulate some ideas and like some ways of thinking before you are actually pursue some data driven ideas, which you still do that sometimes, but it's a healthy balance between the two.
Yeah, and going deeper in that topic of portfolio construction, do you believe it's best to prioritize assets with low correlation to traditional asset classes, or do you lean towards those with high correlation? And this is a question that many people in Twitter actually sent beforehand, because they would like to know how junior quants deal with correlation. Low correlation to traditional assets can enhance diversification, right? Which was something that you previously mentioned, the very, very important topic you mentioned a few minutes ago. And then high correlation might offer that stability, but how those funds strike a balance between those two?
Yeah, so I think there is no golden rule really, and it's quite depends on what time horizon you're talking about, and what objective of the strategy is. But some ideas that all pretty much always come into the picture is are that, or more like assessments that you would want to perform, is that uh, crypto, some of the strategies that are having longer time horizon, you rely quite a bit on the liquidity, and there could be cases of short squeezes or long squeezes. So you kind of need to be diversifying your size. If you're running quite sizable portfolio, then maybe you that would restrict your universe quite a bit. So you definitely want to think about the exit door, and so that like it's big enough should your signal change very quickly. Because as we've seen that like information dissemination and like price discovery is not necessarily the most efficient in crypto, which is a good thing and a bad. The good thing is that, well, that there are opportunities that way, but then sometimes it's crazy enough that some wrong things can escalate and keep on getting to that size that you'll be a forced a closer of the position, which is rarely a good thing. So for correlations, you definitely you using like economics 101, you definitely want to have a lot of uncorrelated assets. But in crypto, most of them are very correlated, and there are some huge idiosyncratic risks where there is a news, and then some coin, irrespective if it's top 10 or top 1,000, can increase in price by 2x within like few hours or a few days. At that point, you really don't want to have 50% of your fund or of your portfolio you know be have exposure to that coin. So you kind of really need to have very tight risk management and very good execution, both on entering positions and managing the exit.
Thank you for those insights. I would like to touch base also a very interesting topic on market inefficiencies. They can arise from information asymmetry and volatility mainly. How do you think that the presence of institutional players who often have greater access to research and resources might influence the speed at which those inefficiencies are corrected? And is this something that you take into account every single day?
Yeah, I mean, you definitely need to process quite a lot of information to make sure that your bets around where the mid prices are quite accurate, and information dissemination and propagation through the well, global order book, if you want. I think it's not too bad already, and it transpires quite quickly. Like you could watch it around some major news, both from TradFi and otherwise. Um, there are definitely some quite sophisticated algos that are watching what's going on Twitter, what's going on the news channels, and are rushing to incorporate that information as soon as it happens into the global prices. And so obviously, as more and more sophisticated guys come into the picture, as they deploy more and more capital, then prices, will gravitate towards the fairer price on average. Like one way to track it, and it's obviously not perfect, but the quantity of liquidations. Like in 2021, 2022, there were like such a big amount of liquidations that were happening, and that's just far from being the case these days. This, that said, obviously, in August 17th, there was one of the biggest liquidation events ever. It was like $1 billion across all the exchanges. So it still happens, but it's much rarer, and that's more like just extreme cases. So the more sophisticated guys that there are, the better informed they are. It's almost kind of goes. It's almost like a corollary that market becomes net more efficient.
Yep. And based on this last word, information, what do you think that new asset managers need to consider when trying to create those first robust trading strategies? What are the first few things that will save them millions?
Well, so it's as always. It's like, do you know what your edge is? As the famous saying goes, if you don't know who is the sucker at the poker table, then you are the sucker. So if you just coming into the game and thinking that crypto is volatile, so there is a lot to do. Well, there is, but now the the arms race is quite far advanced. So like a relationship with exchanges, the fees, the connectivity, the throughput of your systems, the quality of your data, the mind share of your researchers, the whatever else that are contributing to the overall success of an enterprise. They're playing quite a big role. Same way as like I don't know what the exact statistic is that a lot of people lose are much better off just buying the index rather than thinking that they're next Warren Buffett or Ken Griffin, and just sticking with the market. They're much better off just not expressing any views because well maybe their views are not particularly good, and that also generalizes well from like retailers to the to the institutions. Like a lot of the liquid funds, a lot of money managers that we've seen in the space, they kind of confuse better returns with alpha returns, and the fact that you just buy not Bitcoin but like some shitcoin and it increases 2x versus Bitcoin with like 5x volatility. Maybe that's not reproducible necessarily too often, and so I think again, really being honest with yourself and trying to understand like what's your edge, what advantage you have, because otherwise, you're just better off buying Bitcoin or investing in infrastructure and having like big big picture view and positioning for it, or maybe providing some services, which is another huge thing, which is probably much more actionable for a variety of the investors. So improving their settlements, improving their transparency, improving the some constraints that they have that are costing them quite a fortune.
Right on, Nikita. Nikita, right on. I think I totally agree with your last approach, and I would like to conclude my set of questions with one more, and this is going to be with market neutral strategies. What factors or insight led you to prioritize market neutral strategies? Again, I've been following your research for quite a while, and if you can maybe share with us a few of the advantages of this approach, and why your focus has always been on this.
Well, so basically, I'm the chef that eats his own cookies, and so like what I'm preaching, I'm actually a buyer of it myself, and so the starting point was that okay, we've been given the opportunity to have a go at it, but then like we have very mild evidence to think that that we have an edge, right? And so um, I don't know where the price gonna go up or down or sideways or wherever, and so I should rather focus on you know really expressing my bets, expressing my views in a such way that doesn't really expect markets to go up or down. So really trying to create a strategy that harnesses volatility or or market mispricings, which essentially that was the first principle that we need to build up our conviction that we have an edge, that we can make money out of it, and that we're good enough. And so that took quite a few years to get to somewhere. But then at the same time, we kind of wanted to use our disadvantages as our advantages. So the fact that we were starting with well very little actual practical knowledge and experience, so how can we make a positive spin on it? Well, maybe is that we have much longer time horizon, that we can master the skills and nurture the skill, because we're starting so early, and so we should rather optimize for the long game such that we survive rather than us trying to front run the next trend and being 2 years faster, but then lowering our chances of getting to the end line by 10x. So we kind of always with a principle of making good EV bets, expected value bets, with a long-term vision approach. So wanted to minimize the blow-up scenarios essentially, and market neutral strategies are, in my mind, is one way to do it.
Thank you, Nikita. Great insights. Again, I think all of us are, myself, I'm taking mental notes of everything you're saying. Really, really good knowledge. Just to start wrapping up, I have three questions from the public. A week ago, Binance VIP and Institutional asked all our followers on Twitter to send those questions for you. I would like to say it was extremely difficult to pick a question because we received so many. And as you might know, well, we have limited time. So we try to pick the best three. And the first one is, can you provide some insights into the future trends and developments of the world of future quantitative trading strategies? How do you think in the crypto space specifically that this environment will progress and get transformed?
Yeah, so I think there will be definitely much more investment and like much more maturation into the networking, into the just sophistication of exchanges and strategies. So I think like the benchmark and the barriers to entry are always increasing, and you always need to reinvent yourself to just stay to keep your position. And I think as the class grows, as liquidity becomes ever more prevalent, as more and more sophisticated guys come in, I think like people have to take a much more serious approach to it. But that's kind of is really exciting because I think right now there is a bit of a gap in the market. So if you frame all the strategies through the lens of time horizon for the trade. So we have HFT firms which are extremely fast, almost no holding period for the trades, all the way to like venture guys. I think like there is quite a lot of concentration on the HFT front and very short term strategies, and then it becomes days to weeks, 2 years, that are people mostly running discretionary. And so I think like there will be much more development and much more mind share spent on this middle of the frequency time horizon, and more CTAs, more quant funds, more startup funds that will be coming into the picture, and also like greater diversity of instruments, which again will breed more and more strategies, more and more vibrancy to the ecosystem.
Really interesting what you said about the concentration. I think it's one of the first times that I heard about this specific insight. And I would like to ask you, how do you think that gap? How long will it take that gap to be completely filled? Do you think it's going to be in next years? Do you think it's going to take more than a year? How fast do you think that can happen?
Well, so I think people tried it, but I don't think like too many succeeded because running strategies on an asset class with such role is very difficult. And so as volatility of the asset class decreases, which is pretty normal, as concentration of advanced market players increases, as leverage in the ecosystem decreases, um, the volatility shrinks. At that point, there will be more and more advanced players. So your TradFi big names that are quite actively looking at the space, and tons of their guys left and joined some crypto companies, launched their own quant funds and so on. But very few of the tier one TradFi institutions like quant funds joined the space, mostly because they can't run as big size as they would want to, like for multi-billion dollar or like $10 billion plus hedge funds, like deploying 100 million is just not interesting. they would want to deploy at least 500 million, and the largest crypto funds are on that level, and there are very, very, very few of them. So that's kind of is a bit of challenge. Then regulation, and but they will eventually come in, and time horizon is difficult. And I think like a lot of them will have a lot of restrictions and so on. But probably 2 year time, unless there is fast lane that emerges because of some quick advancement. But these things usually take a bit longer.
Yep. Passing now to the second question made by the public, and this is actually from a junior quant. He's just starting in his career. He asks you, how can you effectively balance risk and reward in your portfolio in order to maximize returns? What are the key metrics that any quant should pay attention to, or that you personally rely on to measure and manage your performance in general?
Yeah, so I guess for quite high frequency trading strategies, the set of performance metrics are a bit different, because when you're operating in the structural alpha game, then it's the return profile is quite different, and it's largely not accessible by many, because it's really, really competitive. But more, I guess, focusing on the medium frequency, what you want to do, and again, that's where it comes to the philosophy, and like really understanding what's your optimization function. um, you actually you definitely want to care a lot about drawdowns. So you want to really have tight risk management, and really try to maybe sacrifice a good chunk of the upside by just making sure that you play the game, and that almost under no circumstances that you blow up. So that's kind of is the worst game over that can happen, is that, well, that you actually suffer so much of a loss that you can't continue to play the game. The idea is to always stay in the game, and hopefully progress through the ranks, and wait for the bull market when the opportunity comes, and that fat pitch emerges, so that you could strike it as hard as you can.
Thank you for that. And finally, to wrap up today's episode, the last question from our followers is the following: what are the key features of that allow quant funds to outperform in current market conditions? And even though the follower didn't specify whether this is a bullish or bearish market condition, I would like to ask you your perspective on both. What do you think quant funds need to focus on bearish market conditions and bullish, if you can personally divide the two?
Yeah, so I think in general, like in bear markets, it's tough for everyone. People really like to anchor themselves on good times, and even if good times are really exuberant, they just extrapolate and think that just gonna get better and better. And this mean reversion, or like cycles, are really vital part of how world functions, and how especially financial markets and economical cycles operate. And so you definitely in bear market you want to survive. That's kind of the only thing that you should think about, is how do you make decisions such that you get enough time before market reemerges, and where it gets a bit more complicated, because it's not always mean revert. Sometimes it actually keeps on getting worse and worse, and it just never comes back. So at that point you need to have some hard stop, which is, again, it's really, really difficult, and very challenging thing to master, and like be optimal in that decision. But much simpler one is really getting yourself enough runway to survive, to fight another day. And as we've seen with a lot of industry titans back in 2000s, where Tiger Management was one of the top three biggest funds, but then they essentially shut down and wind down some of the most successful fund ever, just mere months before the bubble burst. And so with these things, again, you just never want to be a forced seller. You never want to run out of capital, or wind down just a day before. So just really being prudent, and uh, being extremely focused on um, learning as much as you can, and like improving and being very focused, so that when the bull market comes around, then you really position yourself to take advantage of the market opportunity. And and maybe you could even make few bets, try to predict few trends. So it depends on the position that you're in. For the bull market, is that right, it's actually the opposite, and that there is so much to do everywhere, and like there are opportunities everywhere. And so you kind of need to normalize opportunity based on complexity and expected payoff. And their like equation kind of flips. You really want to get to the to size and to conviction level quite quickly, so that you make a meaningful impact. I'm kind of intentionally keeping it quite high level, which I think it both includes trading strategies, but also operation of a business, and almost kind of framing yourself mentally, because all those three, from micro
Yes.
to macro, are quite intertwined.
Yeah, yeah, yeah. Nikita, look, it's with heavy heart that we need to bring this episode to a close. But before we actually do that, before we wrap up, would you mind letting our viewers know where can they find you on social media?
Sure. So if they Google my name, I'm on Twitter. I don't post too much these days, but I'm on LinkedIn as well, and there I post quite a bit more. And then they could also visit our website fasanara.com. We have a newsletter, and we publish it on Medium, where we share some views about the market, and some trends that are unfolding that we think are interesting.
Thank you, Nikita. And again, on behalf of Binance VIP and Institutional, thank you again. Thank you for all the support. Your thoughts and lessons have given us plenty to think about, not only to me, but to everyone that is currently listening to you. The majority of those eye-opening. So thank you so much for being part of this episode. And hopefully we can have you again in the future.
Of course, thank you very much. I really enjoyed it.
Great. Well, we have received a few messages of people that want to connect with us and apply for Binance VIP and Institutional. And for the ones that are interested in connecting with us, for anyone interested in connecting with our team, feel free to send us a Telegram message by scanning the QR code on the screen, or to email us as the email that I am currently showing, vip@binance.com. You only need to send us a message saying that you're interested in applying to one of our VP programs, and we will send you all the info. As I said at the start, we are currently working with a lot of market players, mainly market makers, automated market makers, FX brokers, quants, algo traders, building automated trading platforms, OTC desks, hedge funds, high frequency trading firms, fintechs, prop firms, and a lot more. Final, if you like this episode, please tag us, and don't forget to follow us on Twitter and LinkedIn at Binance VIP. And with that, again, with very heavy heart, we wrap up today's discussion. Stay tuned for our upcoming episode. We already locked the next speaker, and it's going to be very good. Nikita, you have set quite a high bar, but hopefully the next one will be equally good. Take care, and until next time.